People, Janet Yellen wants to sell even more Treasury bonds. We've said over and over that the boredom isn't over, but I didn't understand what we meant. We were wrong about how bad it was. At first, I thought they had more debt up front, but it turns out that the U.S. Treasury is also selling more bonds with longer terms. They don't just sell T-bills with terms of 1 month or 3 months. Yellen is going up the food chain by selling treasuries with terms of up to 10 years. Now this is a big problem because they are putting off the issue even more, and the interest payments will take longer than thought. What we are seeing now is our last option, a move to add money to the Treasury account because old debts are coming due. Since interest rates are going up and Congress keeps spending money, they have to refinance the debt and borrow at higher returns. Look at this. The Treasury is selling $103 billion in bills to pay off $84 billion in bonds that are due on August 15, 2023. They are also adding an extra $19 billion to the amount they are selling. So, they are selling even more debt, which is crazy. They are selling everything from 3-year notes to 30-year bonds. This means that Yellen will have to pay interest for a much longer time and at a higher rate. This is the big blind spot we didn't notice. It's not just about taking on new debt. Old debt has also been refinanced at higher rates. When we look at how much it costs to pay back the loan, we see a worrying trend. It's at its best level since 2009, and the average interest rate on all U.S. debt is getting close to 3%. If the Fed doesn't quickly lower rates, this trend will keep going. Normally, this wouldn't be a problem. But we're getting close to a point where we can't keep doing this. Since June, when debt sales stopped, we've borrowed over $12 trillion in just 1 month, and the overall debt is getting close to $327 trillion. Borrowing has a realistic limit, and no country has a magical credit card that can be used over and over again. The Peterson Foundation says that by 2053, net interest costs will make up 40% of government income. So, for every $10 the government brings in, $4 will go toward paying interest on the debt. But I think this number might be on the low side. At this rate of borrowing, the volcanic eruption could be a lot worse, and I think the snowball effect could reach 40% by 2043 or even earlier, in 2033. You might ask why it matters. Well, the longer inflation will last, the more money Congress borrows right now, and as long as there is high inflation, the Federal Reserve has to keep interest rates high. But this bad dream won't end anytime soon. In August, the Treasury plans to sell $167 billion more in bonds with longer terms. This is $11 billion more than the month before, and it includes $16 billion in 20-year bonds with interest rates over 4%. Imagine that the amount of debt continues to grow today and for the next 20 years. So why does the U.S. Treasury keep going after this? The answer is very easy. Either Janet Yellen wants to save money, or she thinks that interest rates will keep going up. She needs to borrow more money, and she thinks that longer-term bonds are better than the other option. We can see how bad the inversion is for the Treasury by looking at the yield curve. The yield curve is very skewed, which makes it expensive to borrow at the short end of the curve. If Yellen picks bonds that will be due in 1 to 6 months, she will have to pay investors more than 5.5%. This is a big cost in terms of interest, but if she focuses on 10-year treasuries, she would only need to issue debt with a return of about 4%, or even 4.2%. By doing it this way, she saves about 1.5%, which is a smart move. She's saving money now, but she's setting herself up for bigger loan payments in the future. We need to understand what this move means. If interest rates keep going up over the next 5 or 10 years, it makes sense to lock in a lower yield now. But Yellen is in trouble if the economy crashes and the Fed has to lower interest rates. If the Federal Reserve starts lowering interest rates, returns on short-term bonds will drop quickly. But because Yellen sold bonds with terms of 5, 10, and 20 years, she will have to keep paying these higher interest payments. This will put a huge burden on the American economy for many years to come. Unless Yellen knows something we don't, maybe she's a genius, or she thinks rates will stay high for a long time. Maybe she has talked to Powell, and he has told her that there won't be any rate cuts for a few years. That might explain what she did. In either case, she might have hurt the business of the U.S., and here's why. When Yellen starts selling many bonds, especially long-term treasuries, she causes all types of bonds to change prices. This includes both mortgage bonds and, more importantly, bonds issued by U.S. companies. Since U.S. treasuries are thought to have no risk, business bonds must be worth more than government bonds. For example, if the yield on a 10-year Treasury bond is around 4%, a business bond with the same maturity date will need to be priced at a minimum of 5%, 6% to get buyers. This is because, unlike companies that don't have a printing press, the Federal Reserve can print money to help bail out the Treasury. The simple truth is that everyone invests in U.S. bonds because they know that the Fed will print money if they need to. When we look at the yields on business bonds today, we can see that they are going up. The yield on corporate debt is about 5-6%, and the yield on junk bonds with a triple C grade is about 13.76%. The more these rates go up, the more pressure there will be on U.S. companies. They won't be able to borrow as much, which will stop growth and lead to a slump inevitability. There's a huge wave of corporate debt coming toward the economy. In the first half of the year, U.S. companies issued a staggering $400 billion in corporate debt. A lot of the debt that was released between 2013 and 2021 is being refinanced and repriced at higher yields. As Yellen sells more long-term bonds, she makes this problem worse. Even businesses with a lot of layoffs, like trucking, are having trouble because of corporate debt. The problem is getting worse because the government keeps issuing more treasury bonds. Let's also think about people like you and me who spend their own money. As more bonds come into the market, our view of risk and reward changes. The average return on the S&P 500 is between 7.5 and 10%, and a year with a 10% return is a pretty good one. But the economy will slow down even more as the risk-free rate on U.S. bonds goes up. This makes it more possible that the market will crash over time. Vanguard, which is the biggest money market fund, now has a risk-free rate of 5.24%. What's the meaning? Now, average investors can get 70% of the usual return from the stock market without any risk. The U.S. Treasury always pays its bills, just like the Lannisters, because the Federal Reserve can step in and print money. You'll get your money back, but that's not the same thing as being able to buy things. Investors will eventually figure this out. If they can make big profits with little risk, money will move away from banks and other investments and into U.S. bonds. This sucking up effect is sure to have an effect on the market. We're in a dangerous situation right now. The shaky economy is kept going by Congress's continued spending, but this reliance on debt is pushing up bond yields. Wall Street knows that this careful balance can't last forever. Morgan Stanley thinks that stock prices will fall if the U.S. government spends less. The big banks know that cheap money is what keeps the market stable, so they try to avoid anything that might upset it. Unfortunately, we still don't know what to do next. We can either have a market crash because bond yields are going up, or a market rise because the government keeps spending money. But one thing is certain. An inflation problem is coming. Congress isn't going to cut back on deficit spending anytime soon. In 2024, there will be elections, which is a big reason to keep the economy going. Biden won't want Trump to win, so this zombie economy is likely to keep going for a while longer. So I'm getting ready for both possibilities. We could have a big market crash because bond prices are going up, or we could see a huge market rise because the government keeps spending money. No matter what, there will be a problem caused by inflation. Congress doesn't seem to want to cut down on deficit spending. As a result, America's finances are like those of the Lannister family in Game of Thrones. They always pay their debts. But the results could be bad. Feel free to tell us what you think in the comments.